So hello and welcome to our Learning Lab live event. This is week 1 and this is your market update. So you have requested to watch this webinar on demand and we hope that you enjoy. So I'll now share my screen with the presentation for you. So we'll be running a series of these Learning Lab live events over the next 2 months. They'll run all the way into September. Each week there'll be a different topic, and this is the first week with the market update. So we're going to start to look at what does a traditional equity release customer look like essentially. So effectively, it would be somebody that's either in their 70s or their 80s. And we know that traditionally, the average age of customer has been hovering around age 71 for quite some years. And in fact, over the start of this year, we've actually seen that change. It's actually increased to age 72. Now, these people may well have fully benefited from house price growth over the last 40 to 50 years. So if we take my parents as an example, they would have bought their property for around about £1,500, and then obviously that's sort of grown. Obviously house prices have gone up. What they've then been able to do is move home and then take advantage of perhaps another move from there on in until the point where they're actually settled. So this generation of customer has really benefited from inflation and the house price situation as it's grown over their lives, basically. Usually this has been a generation of savers, okay? And although most people would have needed a mortgage, they would have probably had a 25-year term and it would have certainly been paid off by the time that they got to retirement. Generally, they're seen as asset rich, but cash poor with limited affordability. So it may well be that their pensions are enough to carry them through on a day-to-day basis, but what they don't have is they don't have the funds for discretionary spend at all. So releasing the funds, okay, for these people generally has been to either supplement their income, fund that discretionary spending. And it could well be that discretionary spending might be a new car. It might be actually home improvements. It could even be to go on holiday. I did see a case recently from an advisor where the client was releasing £35,000 to go on a world cruise. And we certainly haven't seen many of those of late. And certainly what has been a trend is gifting. So quite often parents and grandparents will say, actually, we'd like to see our children and our grandchildren spend the money whilst we're alive to do so. We're also seeing a number of cases as well where people are coming along and their children are actually either getting onto the property ladder, sort of but in their 40s and 50s, and actually it's helping with that, or alternatively where they're actually divorcing or separating from a partner, looking to buy somebody out of a property, or perhaps they're being bought out of a property and need to buy another one. So this type of customer would have had a traditional equity release or roll-up lifetime mortgage, and that would either come in the form of a drawdown or a lump sum. Now, one of the things that we've seen over time is certainly an assessment of the drawdown of additional funds. So actually, because you're securing borrowing for the future, albeit at the rate at the time, this will often travel with a higher rate up front. So one of the things advisors have been looking at with this is actually the drawdown amount that perhaps people are asking for. Is it really what you need, or can you take that at a later stage to try and keep that rate down? Now, we know there have been a number of challenges, and we've certainly seen a lot of clients and customers who've been sitting on the fence. They've been waiting for the change of government. They've been waiting for the Bank of England base rate to change as well. And we know that obviously Bank of England doesn't traditionally sort of affect us too much within our rates, but I want to now play you a video. This is from our Managing Director, Ben War, and he'll be talking about, this was filmed a couple of weeks ago, so he'll be talking about sort of some of the effects and the changes that have happened. So I'm now going to play you the video of Ben. So that was our MD, Ben War. And obviously, the Bank of England base rate has changed. Obviously, that changed at the start of August. And as he has said, those rates are baked in. However, they don't have a vast effect on our lifetime mortgage rates. What happens there is they're often controlled more so by what happens with gilts and swap rates. And the graph that we've got here, so the green line is the tracking of the gilt rate since 2019, and the darker line at the top, okay, is the average AER, okay, for the lifetime mortgages. And you can see that they do generally sort of track quite well through, for each other. So what we've generally sort of seen is that obviously this has led to an increase in interest rates, and that has actually sort of been quite a challenge over the last couple of years. So gilt rates have actually risen by over 600% since 2019. And if we go back to December 2020, that's probably the lowest rates that we saw for equity release mortgages. And I think we were running at around about just over 2.2%, just shy of 2.25 from memory in our own rates. And ultimately, what we've got there is since that period of time, we've seen rates sneak up and sneak up. And then obviously we've got the Trussonomic period where actually, we really did have that boom in interest rates. 50 to 100 bips were happening overnight. And it was just something that hadn't been seen for really quite some time. But then with that rise in interest rates comes another challenge. And it means that obviously, the funders can only offer lower loan to values. And many of those product shelves were pulled. Some of them have returned and some of them haven't. So obviously what the funder has to think about in this instance is the no negative equity guarantee. So the higher the rate, okay, the more risk that they have got from that point of view. But what has happened sort of since then is basically there are some new products that have come to marketplace to try and really combat these market challenges. And it's all designed to give the customer the best possible outcome that there is. So what are the challenges for today's later life borrower? Well, we know that 1 in 5 people will retire with an outstanding mortgage. So if we go back to that traditional equity release customer, this was the nation of savers. They didn't have credit cards. It wasn't a thing back then. They certainly didn't want to owe people money, and the mortgage was probably really the only main amount of borrowing in general that they probably had. But obviously here we've got a very, very different story that's emerging right now, with many people who'll be carrying their mortgage, through into retirement. 61%, okay, is the average monthly payment has sort of risen by since 2021. I saw a case the other day where a client's mortgage payment was actually going from £1,000 a month to £3,000 a month, and it's just not sustainable for everybody to be able to afford those kind of rises. We also know that 82% of residential refinances in 2023 were from product transfers, which had gone up 17% year on year. And if I look at my own situation, when I bought the property that I have today, then that was a case of I was self-employed, I was earning a good income, I could evidence that income. And then ultimately, I probably took a 5-year fixed. And when that 5-year fix was up, I was still self-employed, but in a different guise, and I wasn't earning the same amount of money. I therefore couldn't support a normal sort of remortgage review, if you like. So I stayed with my current lender, and that kept things very simple, because what it meant was we didn't have to re-underwrite the case, my income didn't have to be re-underwritten, I didn't have to have a valuation, and I was literally just switching product. And it became a really sort of easy sort of situation to work with, and it was generally sort of hassle-free. But I think some of the things that we have to think about with these cases is it's just kicking the can down the road for a lot of people. It really isn't actually resolving the problem overall. So what we've got now is we've got a different type of customer that's really coming into the marketplace. So the emerging later life customer. But 60% of these over 55s believe there is a lack of choice in financial products that are tailored to them at their age range. And I think you and I will agree that obviously the spectrum of products has widened over time quite a lot more than it used to be. And I think there's a bit of an educational piece around this to do with clients in client banks that are coming up to this particular age. 36%, so more than a third, have found that their mortgage restrictive is due to their age profile. So this, again, this age barrier, they're in limbo land, unfortunately, so they're not in the general mortgage territory, but they don't see themselves really in the equity release territory either. So what does this profile of customer look like? Okay, so they're usually younger, in their 50s to 60s. And these people might have seen sort of slightly less benefit from house price growth than the previous generation would do. So if I take myself, I'm not actually in this age bracket as yet. However, for me, I referenced my parents having bought their first house for around about £1,500. And actually for me, my first house cost me 54,500. So that was a bit different. I hadn't benefited, from that mass increase over time, but I did benefit, from, other moves, but just not as much. It may well be that this type of customer might have stepped onto the property ladder sort of even part way through the boom, okay, and then actually sort of stayed where that they were, and then actually upgraded their home at a much later stage. The likelihood is that they will still be working, and this is the difference, okay? So we're comparing the initial kind of customer demographic, okay, who are the nation of savers. These guys are more likely to be taking their mortgage with them and other associated debt into retirement. So a very different type of customer. And what these people are generally trying to do is balance their retirement planning with managing their existing property debt. It may well be that they've taken on extra debt as well. So we've had COVID to deal with. We've also had a crisis, in terms of obviously bills going up, etc., etc. And all of this actually sort of amounts up to people having to actually borrow additional money to survive on a day-to-day basis. And all of that, they're trying to balance with their retirement. So a lot of this will be carried forward. So we know that the chances are they're already engaged with the financial sector. There's often limited flexibility in product solutions. So some of these solutions just aren't working for them. And then these two things go hand in hand. So the duration of a payment term, along with affordability, will play a key role into actually what can they get lent to them? Okay, what can they borrow? Okay, and will it solve their problem as they choose to move forward? So age and profile is basically making this type of demographic of customer actually more likely to benefit from some of the new products that have come into the marketplace, whether it be paying full interest or even part interest served. So let's look at products and we'll see where that takes us. So this is where everybody in the mortgage world starts their journey with a residential mortgage, and you have to be able to have good affordability. So you have to be able to demonstrate that you can borrow the full amount that you need, even at a higher interest rate, okay? Because obviously these types of mechanisms are now built into the mortgage world that perhaps weren't there sort of 20, 25 years ago. But then as we've got people coming off of residential mortgages and you've got this emerging later life customer base, okay, starting in their 50s, it might well be that a retirement interest only mortgage could be the way forward. And that was one of the first sort of set of products that was available for them. But now what we've got is the likes of payment term lifetime mortgages and also interest reward lifetime mortgages as well, okay? So there's a different choice that's out there for the customer. And then if we go back to our traditional equity release customer, it was for these people actually a roll-up lifetime mortgage, or alternatively a reversion mortgage if that was suitable. Now, what we're saying is some of these traditional equity release customers, depending on their age, might actually also like sort of some of the new products that are around as well. So let's look at our flexi payment term lifetime mortgage. So what we've actually got here is on the vertical axis, we've got loan to value, and on the horizontal range, we've got the customer age. The blue line on the bottom, that represents the highest loan to value lifetime mortgage that you can achieve. And the green line on the top shows you what a flexi payment term lifetime mortgage could be released at. So the graph in essence is showing you that a 55-year-old customer, in essence, could achieve sort of around 7 to 8% more, okay, by taking that type of product than what they could do, okay, from a normal sort of larger sort of maximum release type loan that's in the marketplace. And in effect, what they would have to do is to get that type of loan, they'd almost have to be 5 to 6 years older to try and get the same amount of borrowing. So this is a lifetime mortgage that requires a part interest payment for a fixed payment term. And that part interest payment, okay, is made up of the difference between the two loans. So the accelerated amount of borrowing, this uplift, if you like, we're only assessing affordability on a smaller part of the loan. And that makes that more appealing, because when we consider comparing that to the likes of a TIO or a RIO, okay, so a term interest only mortgage or retirement interest only mortgage, where the whole of the loan has to be able to be covered. This doesn't. So this makes this much more affordable and accessible to that customer base. So who is this product for? Well, as it stands at the moment, it's for people aged between the age of 55 and 62 and 364 days. That will move in time, okay? So this product, as it stands at the moment, is in a larger part of the pilot, okay? And actually, it's for those people who've got the ability and the willingness to actually make a mandatory payment on a monthly basis, albeit a smaller portion of interest than it would be if it were a residential mortgage or even a RIO. And it's for those people who would like the flexibility to stop making regular monthly payments sooner. And we'll talk about that in slightly more detail in a second. It's also for those people who would like to secure the guarantee of tenure sooner as well, because all of these products that command a mandatory payment do have a risk of security of tenure. So let's look at how that compares across some other products. So here we've got Julie, she's 55 years old, she's got a £500,000 property, and she would love to borrow £120,000. So she's got a couple of different choices. She could take a term interest-only mortgage at a rate of 4.28% APR on a 5-year fixed basis, and that would be at a monthly payment of £431. Her contractual term would be 15 years, and she would be age 70, okay, by the time the contractual term came to an end. Now, obviously, what we don't know is what happens after 5 years. So nobody knows what interest rates will be in 5 years' time. So therefore, we don't know what a new rate would be, and we don't know what the reversionary rate would be at that time either. She could also consider a RIO, a retirement interest-only mortgage, slightly higher rate and giving a slightly higher payment of £572 per month. Her contractual term would be 29 years, taking her to age 87. Now, I'm not sure about you personally, I wouldn't want to be in that position where when I'm 87 years old, worrying about, okay, what happens now? I'm 87 years old and I've got a mortgage that I still owe and it's still outstanding, and I'm still having to pay £572 a month on. That's not for me. It's not something I would want to go down that route of. The alternative is that she could come to us and take a flexi payment term lifetime mortgage, slightly sort of different interest rate, okay, so just slightly higher, but it's fixed for the entire life of the loan. And actually, the client will then know where they stand. And the difference is with this, we're only asking for a committed payment of £284 per month. That in effect would give her a contractual term of 10 years and 6 months, okay? So it would mean that by the time she reaches age 66, then actually she would not have to make a mandatory payment at all. So that would have ceased. Okay, so it's a much cheaper option and much more affordable option for her to be able to demonstrate the borrowing on. But let's consider this. Let's consider that actually, Julie decides actually, well, she can afford to pay £431 a month, but what she can't do is necessarily demonstrate that she can afford to pay that month in and month out for 15 years, okay? And that's not sort of adding up. So on this product, the Flexi Payment Term Lifetime Mortgage, you have an option and you can overpay by a further 10% should you wish to do so. So let's take that £431 a month payment and put that into our Flexi Payment Term Lifetime Mortgage. Okay. So what that would do is that would give her a contractual term of 6 years and 5 months. And it would mean that by the time she reaches age 61, actually her committed payments basically have stopped. So she's brought that term down, and actually now she's free from any mandatory payment. Now, if she wants to at that point in time, she can still overpay by the 10%. And what that will do for her is it will help her control the total cost of borrowing over the loan for a greater amount of time. So it's an option that is available for her and would work quite well. So we know there is a need for more holistic advice, and affordability-led advice in a high-rate environment is crucial. We know that obviously the FCA carried out a thematic review, and obviously what they found during that review is there was too much reliance on equity release and not a lot of investigation into the likes of customers' incomings and outgoings. So we also know that 18%, so only 18% of advisors are actually inputting affordability onto air sourcing. Okay, so there are some toggles that are there to actually sort of help with that. Now, if you have got a customer who you've identified can make an overpayment, even if they don't want to make a committed overpayment or are not in a position to make a committed overpayment, but can make those voluntary payments, it really is essential and can help. And we've got a calculator within our website which will show if you're actually making a voluntary overpayment as to what difference that can make to the total cost of borrowing of the loan overall. We've also got tools within Air system, for example, like the Navigator tool. And the way that this works is that you ask the client a series of questions, and then their answers to those questions will actually determine sort of really where this sort of leads you in the advice proposition. It's not designed to replace advice at all. It's designed to complement and back up part of your advice process. And there's some really great tools that you can use. So where does the future of later life lending sort of look, and how does that look like? What does it look like? So we know that customer needs are changing. They're changing all the time. They've changed. So certainly over the 5 years that I've been in this marketplace. So we have to adapt with that change. And as a result of that, there is a new category of products that are being developed to try and give the customer better customer outcomes. So here at More to Life, there is a number of sort of products that we're looking at, and design and innovation is on our minds at all times. It's crucial that advisors are taking a more holistic view of advice. We need to start thinking outside the box more. And the other thing that we need to do is, if we're not involved in the residential market, okay, and we're later life specialists, but we are collaborating with those mortgage advisors in the residential marketplace, then actually we need to ensure that those referral partnerships, okay, are vital to moving forwards to help these emerging later life customers, because those residential advisors will be seeing them, and they need to start educating people in their 40s and their early 50s about what their financial and mortgage future, if you like, can look like. So if we all work together, then actually we've got great outcomes for the customer. Thank you very much for your time and for watching. If you do have any questions at all, please don't hesitate to contact us. But thank you for your time.